Hi, I'm James Eaton.
And I'm Matt Smiler. Welcome to Katz Abosch's Executive Insight Series.
Now Matt, as you know, many of our clients inquire about transferring wealth to children, grandchildren, or other relatives. So today, we're going to discuss gifting. Some of the basic things to know about gifting are that gifting is closely related to estate tax, and that if a person gifts more than a de minimis exempt amount in a given year, then a taxable gift occurs. Such a taxable gift decreases the amount of the lifetime estate tax exclusion allowed under estate tax law. Under the new tax law, that's about $11 million per person. Once a person's lifetime exclusion is exhausted, taxes would be due on any additional gifts.
Gifts can be made in several ways. Cash can be transferred, which is the simplest way. Property, such as securities, can be transferred. In this case, a gift would be valued at fair market value, but the recipient would still have the previous owner's basis. Transferring business interests is more complicated and would likely require a qualified business appraisal or valuation. Note that current IRS regulations may allow certain discounts in this type of scenario. So what is considered a gift, and is this a taxable event? Technically, a gift is when a beneficial interest in property is transferred for less than full and adequate consideration in money or money's worth. All that means that a gift occurs if you transfer assets to someone for less than you could sell the assets for. In most cases, we see our clients gifting to pass wealth to future generations and to reduce the size of an estate for future estate tax liability. James, why don't you tell us a little bit more about how a gift transaction is reported?
Super. Well, generally, an individual is allocated a lifetime exclusion for estate and gift tax purposes. Further, the first $15,000 a year of gifts from one person to another is excluded from gift tax reporting. Annual gifts over that amount are generally required to be reported on a gift tax return. That's a Form 709. Now, there are also special rules for gifting to a 529 plan, which can be split over 5 years. Also keep in mind that transferring assets to a trust, which has other folks as beneficiaries, would also be considered a gift for reporting purposes. Amounts transferred directly to an educational institution as a tuition payment, or transferred directly to a medical provider for medical expenses are excluded from gift tax reporting and taxation.
Thank you, James, and thank you for joining us today. A comprehensive gifting plan is unique to each family. If you would like to discuss these issues or others, please contact your Katz Abosch representative.